Yes, it's on record on both. Okay. All right. Hi, everyone. If you don't know me, my name is April, and we host Windy City REI monthly meetup. So welcome. This is actually going to be our last meetup of the year, and we'll talk about how we're closing out the year after this wonderful presentation. My husband, Julian, is over there. We're both local real estate investors, full-time W-2 employees, and we run this meetup with another fantastic couple, Chris and Angela, who unfortunately can't be here. They just had a baby in August, and so they're enjoying parenthood right now. And, you know, we hold this meetup so that we can share knowledge, bring value, and hopefully provide you guys a community where you can connect and hopefully be a positive impact in each other's lives. Let's thank Navigator Tap Room because they let us use this awesome space every month for our meetup by, you know, grabbing a glass, keeping it full, and just maybe coming here when we're not here. Let's see. And then I do want to welcome Mike Procaccio. You know, when you are building your team, you really want someone who is good at what you are working on. So if you're a small business owner or a real estate investor, you want someone who can advise you on both, especially when it comes to tax strategies. So that's why we're super excited to have him here. He is not only also a real estate investor, he is also a small business owner of some very successful Jimmy John's, and he is also a tax advisor. And so let's give a warm welcome to Mike Procaccio.
Okay. Well, I use this like this.
No, you're fine. That's the way it is.
All right. So do I talk to this one or just?
Oh, you can talk to that one, and then Perfect. This is to click.
All right. Hi, guys. My name is Mike Procaccio. I'm a tax advisor with Pro Financial Services. First, little disclaimer. Anything you hear is informational purposes. Before you act on anything, please talk to your tax advisor first. And then a little bit about our agenda today. We're going to talk about the beneficial ownership information, IRS account, what an IP PIN is, identity protection PIN, a little bit on real estate professional status, depreciation, house hacking, and a little bit on the potential 2025 tax changes. First, a little bit about me. I was born and raised in Schaumburg, Illinois. Married, I have 2 kids, as you can see in the picture there. I currently live in Roselle, Illinois. I'm a Jimmy John's franchisee. I have 2 locations. Started with Pro Financial in 2012. I have 7 rental properties in and around Schaumburg. I typically like the townhouses, 2-bedroom, 1-bath. I've been a guest on the Straight Up Chicago podcast a few times and also spoke at John Warren's Meetup. As you can see there, we're in front of the St. Louis Arch. And for anyone who is slightly claustrophobic or a little bit on the larger side like myself, that elevator is terrifying to go up because it's slow and it's very, very small. So just a little FYI. And a little bit about Pro Financial. I was established in 1977. My dad, Mike Sr., the guy there in the red tie on the bottom, started it in 97. That was his first office. That briefcase, he used to go to people's houses. That is my dad in the denim on denim in that middle picture. And then that's me, and it looks like pleated sweatpants, but it's a small picture, but they are. And that was in 1992 in the office we were in before this one. So we've been doing it for a while. We specialize in working with real estate investors, business owners, and professionals. And we offer tax planning, tax prep, and business services, among others. So let's get into it. First, I want to talk about the beneficial ownership information reporting. So this was required from FinCEN, the Financial Crimes Enforcement Network. And anyone who has a C Corp, S Corp, partnership, or an LLC has got to report to FinCEN about the beneficial owners. It was enacted to prevent the use of shell companies for illegal activities, protect against national security, and support law enforcement investigations. So basically, they want to stop money laundering. And if you own a business that's not doing good things, they're going to have a list of all the business owners, so they're going to go talk to you. So what do you have to do? Before January 1st, if your business was in existence before January 1st, 2024, the deadline to file is January 1st of 2025. If you opened your business during 2024, you have 90 days. If in the future you open your business after January 1st, 2025, you have 30 days to register. And any updates or corrections, you have 30 days after the change. So how do you file? The good thing is it's not a difficult task to complete yourself. There's plenty of videos online explaining how to do it, and it's really only 3 parts. So you have the reporting company information, which is the information about your company. And then for anyone who filed after January 1st of 24, you have to report who applied. So if your accountant applied, your attorney applied, you report their information. And then you do the beneficial owners, times however many owners there are. And a beneficial owner is someone who directly or indirectly exercises substantial control over a reporting company or owns at least 25%. You might be thinking, what happens if I ignore it? Well, I probably wouldn't do that because there's a $500 fine each day the violation continues, and it is indexed for inflation. Currently, it sits around $591 a day. And if you put down the wrong information on purpose and you intentionally mislead, you're looking at up to $10,000 fine or 2 years in jail. So my advice would be don't ignore it. That being said, no one really knows how they're going to reconcile all this and know who files and who doesn't, but I trust they'll get there. So it's easy enough. I wouldn't ignore it. If you want to get the process started, here's a QR code. And this is for anyone who has an LLC or anything with rental properties, even single member. So right there, you can go there and you can file, learn about the requirements, review frequently asked questions. If you don't want to do it yourself, you can use this company, Strategic Tax Planning. It's a company on the East Coast. We've used them for a handful of things. They're a great company to work with, and they specialize in specific tax things like this. Next, I want to talk about what everyone should have is an IRS account and an identity protection PIN. So what is an IRS account? First things first, you can click that QR code to go to the page where you need to sign up. Current features, you can get your tax data and transcripts. You can make and view payments on there. You can create a payment plan if you have a liability. You can view your balances of what you currently owe, and it's free, and it's put on by the IRS, so it's legit. There's going to be some future features, secure IRS messaging, no more 90-minute hold times when you're trying to call. More letters and notices are going to be available, and you're going to be able to scan and enter certain tax forms in there, and they're quickly adding more features. So kind of a quick thing what you'll see when you go on there. So when you click that QR code, you'll go here, click that blue button to sign up, sign in with your ID.me account. If you don't have one, you can create one there. Then this is basically the dashboard. You can see your account status, how much you owe. You can make a payment, sign up for a payment plan, any notifications or letters you got. And you can get your transcripts or any of that stuff here. Then the next one I think is very important that everyone should do is creating an IRS identity protection PIN. So what it is, it's basically multi-factor authentication for your tax return. I don't know if you guys have Google Authenticator or those apps that like generate a number that you can type in after you put in your password. That's what this is, but only for your tax return. So it's 6 digits. It changes every year. And you get a new number each year, so it's not the same one. And it is, you can use it for taxpayer, spouse, and dependents are all eligible for it on the tax return. So each person can have their own identity protection PIN. And again, it's free. It never fails that every year when we're e-filing tax returns, so a couple people will bounce and they'll say a tax return has already been filed for this individual. And that results in a big headache for the taxpayer because they need to file a paper return, they need to fill in extra paperwork and all that stuff. And if the bad person already accepted a refund, it's even more trouble. This will take less than 10 minutes to do, and it's going to save yourself months of trouble in the meantime. So it's definitely a good thing to do. And again, real quick, when you click that QR code, you're going to go here, hit get an IP PIN, and this is it. So it's going to say your IP PIN is blank. You print that sheet and you give it to your tax preparer when they do their taxes. Next, I want to talk about real estate professional status. And if you're in this room, you probably know a little bit about this. But there are 3 types of participation. You have what's called active participation, and that is individuals or married filing joint making under $150,000 can deduct up to $25,000 in losses against their income. If you make less than $100,000, you can deduct the full $25,000 in deductions. And it phases out between $100,000 and $150,000. So an example would be, say you make $120,000. You would take the cap at $150,000 minus $120,000, gives you $30,000. Divide that by 2, and that gives you $15,000, and that's your allowable deduction. The next would be the passive participation, and this is for anyone who makes over $150,000 and can't claim real estate professional status. The losses are banked until you dispose of the property or use to offset other passive income, like other rentals, limited partnerships, or other passive activities. The next one is what everyone wants to be, is the real estate professional. And those are the 11 trades or businesses that you'd have to be in order to be considered a real estate professional. In order to be considered a real estate professional, you need to hit all three of these criteria. So you fit more than 50% of your services has to be in one of these trades or businesses on the left-hand side there. And you have to be working at least 750 hours in those. But let me just explain that a little bit further. So say you work 500 hours just in real estate activities. That's not going to get you, even though it's 100% of your service, that's not going to get you past the 750 hours. But if you work 1,000 hours at a part-time job and you work 750 hours in real estate professional, that's still not going to get you, because more than 50% of your services has to be a real estate professional service. So not only that, you have to materially participate. And that means your involvement has to be regular, continuous, and substantial to the operations of that rental activity. So let me go in a little bit further on that. So for material participation, most people use the top three there, but all 7 are acceptable. And I always get asked what doesn't count for real estate professional status. So education, unfortunately today doesn't count, guys, I'm sorry. Searching for new property, so if you're knocking out a couple hours on Zillow every night, doesn't count. Studying financial statements, managing the finances, preparing summaries, and commuting to your properties, all doesn't count. Keep in mind, it's not 750 hours of being a real estate investor. It's 750 hours of being a real estate worker, meaning the person renovating, painting, signing leases, showing properties to tenants, filling out paperwork. So just to take it a little further, assuming you take 4 weeks off a year, 750 hours breaks down to roughly 16 hours per week, or 2 full work days per week. And if you get audited, you're going to need a paper trail. So say you have a rental property in Michigan, and you say you were there for the weekend redoing the bathroom. But really you were with your family in Disney, and all your credit card statement says you were buying everything at Disney World. They're going to look at that and they'll say you weren't here, and they're going to disallow those hours. So that's with real estate professional. Now let's move on to the next one, depreciation. I want to touch on this pretty quickly. So there's a couple depreciation. You have bonus depreciation in section 179. We're going to first talk about bonus depreciation. The tax break that allows businesses to immediately deduct a large percentage of the purchase price of eligible assets. So that's basically what I said, taking the cost of the asset up front as an immediate expense deduction instead of depreciating it over its life. It's limited to tangible property with useful life under 20 years, certain computer softwares and others, but it's not relevant to this presentation. So this is where people talk about cost segregation studies, where it reclassifies property to 5, 7, and 15-year asset lives. Keep in mind, Illinois does not recognize bonus depreciation, and it needs to be recaptured upon the sale of the property. And it doesn't really help you unless you're a real estate professional or have passive income you're looking to offset. So even the cost segregation guys will say, if you're going to buy a property and then sell it the next year, it's probably not wise to do a cost segregation study. So before you do something like that, talk to your tax advisor and see what makes sense. And as you guys know, bonus depreciation is phasing out. This is the current schedule where we're at, assuming nothing changes, which definitely will here soon. Next is going to be the section 179 deduction. And that is an immediate expense deduction business owners can take for purchases of depreciable business equipment instead of capitalizing depreciation of the asset over a period of time. So what was on that previous slide, it's limited to cars, office equipment, business machinery, and computers used for business use over 50% of the time. Property must be put in place during the tax year the deduction is being claimed. And the limit of section 179 for tax year 24 is a little over 1.2 million. There is recapture upon selling or dropping below 50% business use. It is recognized in Illinois, so that's good. And you can only take this deduction up to the amount of profit. It's not refundable. Whereas bonus depreciation, you can get a refund for it. This drops your income to zero. It doesn't take you below, but that is carried forward. This is where you hear people talk, oh, I got a Lamborghini SUV and wrote the whole thing off on my business. That's not the case because it needs to be regular and it needs to be used ordinary and necessary for the business. And unless you're Floyd Mayweather, it's not ordinary. I'm going to touch a little bit about house hacking. I know we talked about this when we were talking earlier. So for those of you who don't know, house hacking is living in one unit of a multi-unit property and renting out the others. So how the expenses are taken care of. So anything that's for the whole property, you got the mortgage interest, property tax, insurance, all that stuff. If it relates to the whole building, you take whatever it is. So say you have a 2-flat, 50% of the expenses go to you, 50% go to the rental expenses. But if you have a 3-flat, a 4-flat, whatever, it's just a percentage. Keep in mind, you need to accurately allocate those expenses between personal and rental use. And you have to keep good records and track your expenses. So if your rental, the rental side of the 2-flat, they break like 3 windows and you have to replace those windows, that's all on the rental side. So you can expense all that. But if you have to replace your carpet for whatever reason, that's going to be on you. So you can't expense that as a rental. So everything that goes into the rental is expense. Everything that goes to you is not expensed. So what happens when you sell? On the part you live in, you get the primary residence exclusion. And if you live there for 2 of the past 5 years. On the rental part, if you made money on the property, you would pay capital gains. You also have to have depreciation recapture. And it's very important, especially when selling a house hack, to talk to your tax advisor prior to selling it, not after it's sold, because it might change your mind. And then over here, I want to talk a little bit about potential upcoming tax law changes. I'm not going to stay on this very long because it's all going to change next year anyway, but I just want you to be aware of what's changing. So over here, I don't know if you guys can see it very well, but the Tax Cut and Jobs Act in the middle column is basically where we're at now. After, on January 1st of 2026, we're going to go back to pre-Tax Cut and Jobs Act, which is going to be everything on the right-hand column that says post-2025. So look at all that. I'm not going to go line by line because it's a lot, but a lot of this is going to affect a lot of people here. So whether they extend the Tax Cut and Jobs Act as it stands or revert to pre-Tax Cut and Jobs Act, there's either going to be a large tax increase for all of us or the national debt is going to increase. So it's very likely that neither is going to happen and this is going to fall somewhere in the middle. We just don't know where it's going to happen. And depending on how it's going to affect you, it's going to matter how the chips fall in your own scenario. So there's going to be winners, there's going to be losers. It's just a matter of how you fit in there. And it's no matter who gets in the White House, big tax changes are going to be coming. So like I told him I would do, I'm flying through this, even though I'm sorry. But a few closing thoughts. Don't wait to tax plan until April 14th. Not a good time to tax plan. And you're not going to get much bang for your buck there. Go see your tax advisor at least once during the year to complete a projection. Doesn't cost much, and it'll help you know where you stand for the year. The next is don't act on tax advice you learn from social media until you talk to your tax advisor first. And when I say social media, that includes friends, cousins, aunts, uncles, parents, siblings, coworkers, the guy at the deli, etc. And that is because taxes are very nuanced, and what can work for someone might not work for somebody else. So the person who is your coworker, makes about the same amount of money as you, is like, oh, I got this huge refund. You don't know what they're withholding. You don't know what their spouse is doing. You don't know anything about them behind the curtains. You just know that they have the same job as you and make about the same amount of money. So don't take tax advice from someone who is not your tax advisor. And if you do, talk to your tax advisor first. Don't act on that advice. There is plenty of good information out there on social media, but don't act on anything until you talk to them first. And so with that, I want to thank you. And well, thank you for that. My contact card is up there in case you guys need it. And I'll open it up for any questions if you guys have them. All right. Yeah.
So, first of all, we're talking about the question. So, one, you have to do a cost ratio study with the advantage of it, and then two, the public hearing would appreciate, is it offset active or passive income? How?
So the question was say the first part again. No, you don't have to do a cost segregation, so you do a bonus depreciation. That just helps reclassify the building into 5, 7, and 15-year asset classes. So that means you can front load your depreciation and get a bigger deduction up front. And that's going to offset passive income. So it's not going to offset your W-2 income unless you are a real estate professional or you have active participation, meaning you make under 100 or between 100 and $150,000. Yeah.
Excuse me, piggybacking off that, mentioned briefly that.
No, it's true. It's it's just not recognized in Illinois. I'm not sure why. There's a number of states that don't recognize bonus depreciation, and you'd have to talk to the state on that one. I'm not really sure why. You can do it for your federal. So the federal return is okay. It's just when you go to your state return, they're not going to recognize it. So, the loss that shows on your federal return is not going to show on your Illinois return. Mm-hmm. Yeah. The year you do it. Yeah. So you can go there and there'll be all that. And the cost aggregation guys are really good. So they'll be able to give you a free estimate on like what it can look like. And then you take that to your tax advisor. Yeah. You can go back and amend if needed, if it's for prior years. But I think definitely depending on your situation, you should talk to your tax advisor first on that one and see. Correct. So it's not going to offset your W-2 income. Yeah. Unless you're a real estate professional. So unless you can classify for that.
Okay.
Or that, yeah. The short-term rental is tricky. You need to do the whole 100-hour thing, and that's a whole nother story. But yeah, so with the short-term rental, you definitely need to talk to your tax advisor because that's going to be a very specific situation. But in general, when you're doing a cost aggregation study, that only offsets your income that's passive, or if you're under the $100,000 mark or $150,000 mark, it'll offset a portion of that. So it'll bring you up to $25,000 in losses against your active income if you're under those thresholds. Mm-hmm. All right, anybody else? Yeah.
So when you mentioned that section 179, I know.
Yeah.
So for like a rental business, how that work? Like, so like the vehicle has to be solely for business purposes.
Over 50% for section 170.
Oh.
Yeah.
So that would be, so like if you buy a car,
No, so the business use has to be over 50%. So not the price. Depends on the car. So if it's over 6,000 pounds, you can write off the percentage you use for business. So if you buy a $20,000 car, you can't write off 50%. You have to write off the percent that is for business use if it's over 6,000 pounds. If it's under 6,000 pounds, then there's calculations you have to do.
or where would LLC?
You can do it personally. You can do whatever you want. Sure. Yeah. Yeah. Or rental properties, you don't really need to do one. What would you be looking to gain from that? Just I think LLCs would be just fine with that. Depending on your specific situation, that's where it gets into the weeds. But we have people who have 60 units that are just LLCs. So it's not necessary. Yeah. 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 Yeah.
Stuff with the LLC because they not that from the money you make. Or you could that.
The S corp is really not used for rental properties. That's for a business. So for a business, that is true. You pay yourself a W-2, you pay yourself a draw, and you are not paying self-employment tax on the part you take as a draw. For rental properties, that has to be like your business. You're buying and selling, whatever it is, but it's not the casual investor who has a couple properties is doing an S corp like that. Yeah.
Isn't the LLC what you cover
The LLC doesn't do anything for tax savings. It's a firewall between your personal assets and anything that happens at the property. So if someone slips and falls, they can only take what's available in the LLC. They can't come after you personally. Yeah, assuming you're not allowing them to pierce the corporate veil and you're not commingling funds and all that stuff. You gotta keep it separate. But yeah, that's exactly right.
So after how many
That's a personal preference. You know, you're kind of, if you have a mortgage, you're liable for the amount of money that's the equity in the property. So it's just however much you're comfortable risking, really. You know, some people do it every property, which I don't recommend because it's a lot of paperwork. Some people do it every 5, people do it every 10. It also matters what kind of asset you have. If a very expensive asset or there's a multifamily, there's a lot of people living in there, maybe get an LLC just for that one. You know, but if you have a handful of properties that are around $150,000, $200,000, you can lump them together in one LLC, and I think you should be okay. But again, for that, talk to an attorney or tax advisor. Mm-hmm. Oh, all right, we'll go in the back there first.
LLC,
Mhm.
that you own outside of that. Lawsuit and, you're trying to come in.
That's more of an attorney question than a tax advisor. That's more of an attorney question. You know, I wouldn't know too much about that. Yeah, estate planning, yeah, estate attorney, yeah. Yeah. I've never personally heard of it with any of our clients. Yeah. All right, and then you in the front, yeah.
So with some of the bonus depreciation, you touched on, really beneficial. Maybe dig a little deeper in that, give us a hypothetical. Truly benefits you.
Yeah, so if you're a real estate professional, so say you're a married couple, one of your spouses work full time, they make a lot of money, and the spouse is a real estate professional and they're managing all the rental properties, they're hitting the 750 hours, they're hitting the 50% of their time, all that stuff, material participation. They can do a cost aggregation study and use that front loaded depreciation to offset the active income of their spouse. That's what a lot of people use it for when the spouses like that. That would be the main scenario. Yeah. What do you if they were depends how that flip property is classified. If it's on the Schedule D, so if it's a capital gain, no. If it's on a, let's see, if it's a Schedule C, are you flipping properties like multiple times a year, or is it just like a one-off, like every couple of years? Mm-hmm. No, the passive does not take away from the active capital gains. Capital gains would not be considered passive income, so it wouldn't help. Correct. Mm-hmm. Yeah.
So you said that.
Yeah.
Are there any other
Well, what you're doing is you're taking all the depreciation up front. So you're taking a bigger bigger deduction up front. So you're going to lose a lot of it more in the end. So what you're doing, if you're buying a property over 2 or 3 years and you can take advantage of the advanced depreciation, that's fine. But if you're doing one and you take all the depreciation in the first couple of years, then you have no depreciation to offset the income of the remaining of the year. So again, that's personal preference and how your situation pans out. But that's what it's doing. It's advancing all the depreciation, taking most of it up front, and then you just have a small amount carrying the rest of the time.
So you can get strategy like classification.
If you qualify to offset that, yes. Yeah. Mm-hmm.
Piggybacking off that, but kind of zooming out a little bit, I guess. Can you take it in phases? So, let's say here, can you take it across?
No, because then that would just be, I mean, if you're going to take bonus depreciation, you got to take bonus depreciation. So, yeah. Yeah, because then you're just taking regular depreciation. Yeah. Yeah.
So then do you have
Have some losses. Yeah. 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 There's not much, not much you can do, unfortunately, unless you become a real estate professional. Yeah.
so if you're
You can do a cost segregation. Oh no, then if you're a real estate professional, you can offset the capital gains because you can offset passive against active income. That's a pretty specific question. It's like a per person basis, so it's not like a general question. If you have, I mean, you would basically take what you have as a passive loss and it can offset your passive income. So say you have a $30,000 passive loss and you have $100,000 of income, you would now have $70,000 of income. Or whatever income that is. I'm talking just income. Yeah. 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 There's a de minimis that you can have. So 20, yeah, you can depreciate kind of whatever you want, but anything under $2,500, you can write off that year and not depreciate. It's called the de minimis, and you can write that off. Anything over that, you should depreciate. If it brings you down to zero,
say you make
179, carryover, yes, yeah. Mm-hmm. So for section 179, you can only bring it down to zero. So it can't bring you down to a loss. So say you have $1,000 in profit, you 179 the asset, and there's like a $2,000 loss. So you can only offset that $1,000 of income. The 2,000 carries over to the next. Yeah. Anything else, guys?
So let's say I'm working with the CPA already.
Yeah.
Does your group kind of work to help strategize with the client, or you recommend just firing the CPA?
I mean, you can, that's up to you, really. We work with a lot of people who are, in real estate investors. We're with a lot of small business clients, and we don't like advising clients who go to other tax preparers because all the tax preparers think they know better than all the other tax preparers. So it's hard. Yeah, exactly. It's the same type of thing where, like, one person will say one thing, one person the other, and a lot of tax information is also how you understand it and how you, like, there's a lot of nuance in there. So you got to really understand, and you really have to understand the taxpayer, like the client as well. So it would be difficult. I mean, we've done it before, but we like to have them as clients, and then we can advise them. They come in and all that stuff. Yeah. All right. Well, thank you guys. I appreciate it.
Nice round of applause.
Thank you.
Thank you so much. That was a lot of information, a lot of stuff that I'm going to have to look up when I go home. So I have homework to do. Again, just to reiterate, this is our last meeting. There's no meeting for November because it's right around Thanksgiving. So we'll see you guys in December and then the last Sunday of January. Another round of applause for Mike.
Yeah. Thank you.
And then if you guys want to gather, if you don't mind, right by the beer taps, we're going to take a quick picture before we end.